Hi, everyone. Thank you for joining the quarterly webinar for Indicate Capital Fund One. We appreciate you taking the time to be here to listen to what's going on with your investment. One of the core values we have here at Indicate is transparency, and this quarterly webinar is one way that we try to provide transparency to you as an investor. We want to make sure that you understand everything going on with the fund, make sure you understand what's happening with your investment. We also provide quarterly written updates as well as our annual investor meeting in September. So please, if you're new to the fund, pay attention. We love sharing information with you and letting you know what's going on with your money. For those of you who are new, I want to just go through some housekeeping items that we talk about on this call. First of all, we try to limit the time together today to 30 minutes. We really want to respect your time and make sure that we can get as much information to you in 30 minutes as possible. I'll limit my talk time to 15 to 20 minutes. We'll use the remaining time for Q&A. If you do have questions, you can type them into your Q&A bar on your call, and we'll do our best to get to all those questions in the time we have today. If for some reason we cannot answer your question, if I don't have the answer, or if we run out of time, we'll do our best to get back to you. And please reach out to Ben Lorenzen or myself, and we'll do our best to get those questions to you as soon as we can. I want to start today by talking about K1s, which is always an important topic for our investors. I know many of you are anxiously awaiting your K1s so you can file your taxes. But let me kind of give you our process and reiterate where we are on everything. First of all, in order to issue K1s, we do go through a full financial statement audit every year. And we are actively, diligently working on that every hour of every day right now to get the audit done. We're getting close, but we're not quite there yet. And the audit needs to be substantially complete before we can issue K1s. Another complicating factor is we are a real estate investment trust, a REIT. And being a REIT is very advantageous for you as an investor because it saves you an actual money that you have to pay to the federal government. And last year, it saved our investors close to $2 million across the fund. So it's well worth the time, well worth the effort. But there are some complications that it creates in creating K1s. We're still shooting for early April for K1s. And we will keep this communicated to you as we go. We will make sure that you're abreast of when K1s are coming out. But right now, we are shooting for early April. We will distribute those K1s through Juniper Square, which is our online investor platform. They will be there for you. They'll live there for the full time you're an investor with Indicate. If you do need hard copies or if you do need copies sent to a CPA or a third party, please let us know and we'll do our best to do that. Again, if being with the timing of K1s and the complexity that we have to put in to get these done, if you are able, I would encourage you to extend your tax return beyond April 15th. It's free to do. You can talk to your CPA about how to do that. Me personally, I extend beyond April 15th and don't file until October. In fact, which many of you on this call, I'm sure, get the same K1, but there's a K1 that comes on September 15th, which is corporate tax filing deadline. So I literally get a K1 the day that I have to file taxes on September 15th. So I would encourage you to extend your return, but we're really, really shooting to have these out before the April 15th deadline. Now let's move on to what we really want to talk about today and talk about what's happening with Indicate, what's happening in the markets, and make sure that we can disseminate everything going on in the fund that is pertinent to your investment. Let's start with the private credit markets. For a long time, private credit markets and private debt, like what Indicate Capital focuses on, was one of the darlings of the financial industry. It had the J curve of growth on it. It was really kind of one of those boom asset classes. In fact, it doubled in assets under management from 2020 to 2024 to nearly $1.3 trillion. But as we know in the financial world, whatever goes boom has a tendency to go bust. And the private credit world is not necessarily the darling that it was a couple of years ago. There's some stresses in the market. To put this illustration into focus, 2 weeks ago, a Wall Street firm named Blue Owl, which lends on business loans, much different than what Indicate Capital does, but in the private credit world, which I'm sure you have heard a lot about, Blue Owl decided to permanently restrict redemptions in one of its funds. In fact, they're going to call it a controlled liquidation, where they're going to liquidate their entire portfolio. Now, this is just one of Blue Owl's funds. Liquidation, when you're forced to restrict redemptions in the private credit world and the private fund world, and do a controlled liquidation, sends some alarm bells through the market, and it's really rattled a lot of things. But really, we don't see it as a huge negative. Blue Owl claims that they're going to be able to get 99.7% of their investor money back through this liquidation, but the investors and the fund really have no set timing on that. It could take a matter of months, it could take a year or longer to do all this. So really, we got our eye on that, but at the same time, it's not putting any shivers down anybody's spines and thinking that our world is going to crumble in front of us. To put that into perspective, when we look at the private credit world and we look at funds like Indicate in particular, we really see two big risks in funds like ours. And we've really tried to do our best to communicate these risks to you as an investor, but also make sure that we can take as much risk out of the fund using these viewpoints as possible. The first one is the valuation of the assets in the underlying portfolio. What are the loans in the portfolio worth, and what are the assets that those loans are made on worth? In Blue Owl's case, they lent on a lot of business assets. They lent on capital costs for growing business. They lent on operations and other things within that matrix that really are harder to value than what our world is. We lend on hard assets, on real estate assets. We can control the value or not control the value, but we can understand the value of our assets on a fairly regular basis. We can also go out and walk those properties. We can go through them. We can talk to other people, and the value is much more easy to decipher on an ongoing basis than maybe what a business asset is. The second big risk that we have always talked about in funds like Indicate is liquidity. Can you, as an investor, get your money out of the fund when you want it, or when the fund has promised that you can get that money out of the fund? Blue Owl ran into the big snafu here, where they were not able to liquefy the fund in the manner that their investors expected, and that's what's caused the big problem there. Indicate is much different than Blue Owl, and we've talked about this ad nauseum for years and years and years, but it is our core values. We stay in our lane. We do not change. So these values that we operate the fund on, operate Indicate, have not changed since the first day that we've made a loan. First of all, Blue Owl is about 1,000 times bigger than Indicate. It has $307 billion under management compared to our $300 million. We're able to understand our portfolio in a much more tangible way than what a bigger firm can. In addition, we lend on tangible real estate assets. We are an asset-based lender. We can go out and touch and feel the things that we lend on. We can walk through houses. We can go to the buildings. We can do whatever we need to do with these assets. We know what they are worth. And very rarely do real estate assets go to zero. In the case of a business, absolutely, an asset can go to zero. But in our world, very rarely does that happen. So we feel much more confident that we're lending on those tangible assets at a low loan-to-value basis. Second of all, we have liquidity. We've always been able to honor liquidity requests within Indicate Capital Fund 1 on a very timely basis. We've been able to honor, over the course of the fund, over the last 7 or 8 years, several $100 million worth of liquidity requests, coming both from distributions on a quarterly basis, as well as people needing their money back for this, that, and the other, whether it's going out, making a purchase, or getting out of the fund. How do we provide this liquidity? Well, there's two main things that we use to provide liquidity within the fund. The first one is our $40 million revolving line of credit with Western Alliance Bank. That has been just a great tool for us over the course of the last several years to manage the money into the fund and the money out of the fund. Today, as of March 4th, we are only $3 million drawn on that $40 million line of credit. So we have a ton of liquidity. In addition, over the course of time, we have a lot of money coming in and out of the fund through loan payoffs. To put this into perspective, year to date in 2026, over the course of the first 60 odd days of the year, we've had $40 million worth of loans pay off already this year. In 2025, we had over $218 million worth of loans pay off. So we have a ton of liquidity coming in and out. We've been able to honor liquidity requests just like we've always been able to do. So this has not been a problem for us, and we foresee this continuing for the foreseeable future. What are the risks and indicate that we do have to deal with? We are subject to the overall risk of the real estate market, specifically in Colorado and Utah. And these markets have been rough for the last 4 years. The markets have, the real estate markets in both of these areas have been flat to negative over the last 4 years. And this is really where the stress in our portfolio has been caused, is the vintage loans that were made between 2022 and 2024. But we are working through that, and we're starting to see signs of improvement, specifically in those loans. Part of the stress over the last 4 years has been not only the flat to declining real estate market, but it's been the municipalities. It's been everything that our borrowers have had to deal with to get properties from the time they buy them to the time they sell them, whether it's permitting, whether it's certificates of occupancy, inspections, whatever it might be. It has just taken them longer to do properties. And we can specifically see this in the average duration of our loans. Over the course of our 15 years in business, the average duration of a loan has been 232 days over the 3,500 or so different loans that we've seen pay off in that time. To put this into perspective, the long period of loans was the last 2 years, 2024 and 2025, which averaged about 285 days. So almost 2 months longer than our historical average. In 2021, when the market was at its peak, when things were selling faster and we were coming out of COVID, the average duration of a loan dipped to 193 days. Well, so far in 2026, we are much closer to that 232-day historical average at 241 days. So we're really seeing the front end of that portfolio start to turn over quickly and start to get back to a more normalized average that we've seen over the course of our history. Now, whether that continues is a guess, but we are starting to see the real estate market heat up a little bit. Rates have dipped below 6% here for the first time in a long time, which has started to produce a lot of volume out in the market. We're starting to see multiple offers on our borrowers' properties, which we haven't seen in years. We're starting to see things that are really positive in the market, and hopefully that continues to happen here over the next several months. And again, we're working through some of the vintage loans from 2022 to 2024, but we're really getting to the end of that. And we haven't seen a lot of new defaults come in from loans that have been issued in 2025 and 2026. So although our returns are lower in 2025 than in the past, at approximately 9.1%, we feel the portfolio is protected from a value standpoint, and we're very liquid. We very much pride ourselves on that value and keeping your investor dollars at a place where we're not losing our capital. That is our number one priority, no matter what we do. And even through this rough market in Utah and Colorado, the net migration slowing down, the economical headwinds, everything that you can imagine coming at us, we've done a great job of keeping the portfolio at a place where we feel value is there and that you can get your money back when you need to. Indicate Capital Fund One remains a safe and resilient investment. We are completely confident in our lending model and the diversification that our fund brings. Even in tougher times like these, our lending model keeps your investment safe. We will always prioritize the safety of your investment in Indicate Capital Fund One over creating high returns. But we have proven over time that we can generally do both. Even though returns have been lower over the last few months, we are confident that over time we will be able to return closer to our historical averages, and we're working every day to make this happen. It may not happen in 2025, or 2026, but during 2026, we will protect your assets, things will be safe, and we will return solid returns back to you as an investor. So thank you. We appreciate your confidence in what we do. We appreciate your confidence in our model, and our team is continuing to work every day to make all of this happen. So with that, I'm going to open up the floor to questions. Use the last 10 to 15 minutes here to answer as many questions as possible. And again, if you do have questions, please type them into the Q&A bar We will do our best to answer them, and if we do not get to them, we will answer them after the fact. All right, first question. A number of my Colorado multifamily investments have become increasingly stressed by the dynamics of the marketplace. How is this in, how is Indicate impacted by these negative developments in the marketplace? The multifamily has been the tough spot, and you hit the nail on the head by asking this question. Multifamily has been much more stressed than what single family has. Colorado specifically has done the same thing we do in every market cycle: overbuild and then take years to absorb, overbuild, take years to absorb. And we're in that absorption phase right now, and it has stressed the market out. We are fairly optimistic for multifamily here in the next few years. We do have a couple distressed multifamily deals that we're working through, but we feel like the value for the long term is very much there, and we'll make some good money on it. I was at an economic forecast conference yesterday, and one thing they hit on was this discrepancy between multifamily and single family. And single family is really forecasted to be very flat here in the next few years, as is the economy. The economy is not going to go down; it's going to go up at its 2 or 3% pace, but it's not going to do anything like we've seen over the last several years. And really, that's kind of where single family is forecast to be. It's going to be a good place to be. We'll make money. We'll protect assets. But multifamily, I think, is going to start to present some opportunities out there. Again, we'll see what happens. Interest rates coming down are definitely going to help this out, but we'll see what's going on. Origination of three smaller loans in Little Rock, Arkansas in late 2025. Can you elaborate on these? And are there plans to expand in this market? Will we get an Arkansas K1 next year? K1, no, you won't get an Arkansas K1. Being in the REIT, we're able to put that all under um, kind of our master K1 for the federal level. So yeah, you won't get an Arkansas K1, but those three loans in Arkansas are to one of our best borrowers that we've dealt with over the course of years and years and years. And he saw the opportunity to expand into Bentonville, Arkansas. These are smaller kind of single family duplex type of builds. We're just kind of dipping our toe in to see what's happening there. We feel like our loan to values are rock solid there. We feel like they're great assets. And just like we did several years ago, for those of you who were here when we went into Nashville, Tennessee, we did great in Nashville. But again, it was a market that maybe when we got into there, the loans we made were a little different than what we thought they were going to do. We got all our money back. We made all our interest. There were no problems with them, but we decided to move out of Nashville for the time being because of COVID and some other things. So again, we're just dipping our toe in Arkansas for right now. Has there been a shift in asset type borrowed in the recent past? Yeah, there's two interesting things on this. So I'm just going to pull up a little note I have down here to make sure that I give you the right info. But we've really kind of refocused our world on single family assets. Our average loan across our portfolio, including multifamily, including commercial, is just over $1 million right now, which has really shifted our focus on the smaller assets. And we felt much more comfortable on the single family type of asset over this period, not just because we feel like we can de-risk them more, but because if we do default on them, or if our borrower does default on them, we're able to turn that asset over quickly. We're able to sell it quickly. If we have to do any rehab, it's much less time consuming. So we've focused more on the single family, although there are some good opportunities on the commercial world. And we do have some very good assets that we're looking at there. We've recently brought in a new loan originator, Nick Hodap, who is going to focus on the commercial side, and he's brought a wealth of expertise to us that we didn't have before. So we will look at that, but again, we've really focused on the smaller side in 2025 and even 2024. How does the percentage of 2025 loans in default compare to the 2024 percentage? How about number of foreclosures in process at the end of both years? We're at a low point of REOs that we've been at here in the last couple of years. We're at about $27 million. We have two of those under contract to sell. We're getting rent on several other of them. One thing that we've always kind of told you as an investor is we're very cautious about our REOs, and we're not going to sell them just to sell them. They're great assets, and they're assets. And what I mean by assets is you don't want to sell at a market low when there's value there to be had. So we're really making sure that we keep our eye on these, renting the properties that we can rent, selling the properties that we can sell, but doing it in a smart, methodical manner that will protect the fund, A, B, get us all the money that we can possibly out of the asset, and C, if there's profit there to be made, we want to make sure that we sell it in the right phase of the market. As far as foreclosures go, we haven't seen, as far as numbers of foreclosures, we haven't seen a significant uptick. In the last several months, we're still dealing with some problems from that 2020, even 2021 to 2024 vintage loan. And we're getting through those. We feel like there's value there, and we'll do what we've always done and really make sure that we get through those in a good way. Are you collecting rent on any properties? Yes, we are. We're collecting rent on a significant amount of our properties. So again, if the market's not right for us to sell a property, if it's able to be rented, we're gonna go out and rent that. For instance, our oldest foreclosure is 1360 South Wadsworth here in Lakewood, and it's a small suburban office building, and we've held on to that for years. We're 94% leased on that property right now, and we are producing cash flow, and we are producing returns for the fund through that. And when interest rates and everything comes back, we will sell that and hopefully make a couple bucks for the fund. But in the meantime, we are producing returns for the fund from that. Um, Forgive me if I butcher this name, but Adam Posen of Peterson Institute recently purchased a compelling paper projecting that inflation will be at 4% by the end of 2026. If this happens, what would that mean for the fund? Yeah, the economic forecast I attended yesterday was not too far off from that. They thought inflation would be um, fairly high in 2026, come down in 2027, and go back up in 2028. We've dealt with it in the last few years, and it has affected things, and it's made things less affordable for people. But again, um, inflation is one metric that we have to deal with, and one metric that the end consumer has to deal with, and makes things less affordable for everybody. So I guess my thought on this is I absolutely agree with what he's saying there. We have our eyes on this. Um, we've been through it in the last few years, and it probably has caused problems. Will it cause more problems? I don't know. The good thing that's happened is I think this flattening out of the real estate market is very healthy for the long term. And I think that if inflation does come back at a meaningful way, like 4% or higher, that we've at least kind of sat on the sideline for the last few years as a real estate sector and not seen those double-digit increases. So I think things will be more affordable, especially if interest rates can come down a little bit. How is the demand side of your business? Demand's been strong, specifically in Utah and Colorado. We've again, I mentioned the fact that we've gotten $40 million of loans paid back so far in 2026. We've had $43 million of loans go out. So we've been able to very much manage our supply and demand there, and the demand looks pretty strong going here into the spring. Utah's been a great success story. I don't want to forget to talk about them, and the team out there led by Megan Rojas has really turned Utah around. We're down to 4 foreclosure properties out there with 1 under contract to sell. So we're really coming down on that level, and the loan portfolio has been doing great out there over the last 12 months, and we're really excited for that as well. Our foreclosures moving more specifically in Colorado. Yes, we have 2 under contract, 1 in Utah, 1 in Colorado. Again, we're very much protecting the value. We're in March right now, the very beginning of March. This is the annual cycle of the real estate market. Things don't really start to heat up until maybe April. So we're going to see more things move here in the next couple of months, especially with interest rates coming down. So we continue to sell things, and we'll continue to do that as we go. What do you think the return will be for the remainder of 2026? Will we hit 10% again? Is your return fixed? First of all, no, our return is not fixed. We've never promised a fixed return that would put the portfolio in undue risk. But the return for the remainder of 2026 will most likely be closer to where it was in 2025. We might have first quarter is always tough for us. There's a lot of unknowns, but we're really starting to produce good loans again on the front end. And we're just kind of still dealing with some of the 2022 to 2024 vintage loans. Once those get worked out, that's when we'll get closer to that 10%, but I don't think it's going to be in 2026. Is Indicate actively looking for new money to invest? We are actively looking for new money to invest, specifically from current investors. We are reaching out to new investors, but uh, not at the pace we have in the past. We look for money from our current investors first, and then if we do have outside investors that want to invest, we will talk to them. One of the tricks with our business is to match supply and demand. Our supply is the money that we have available to us, our investor capital. Our demand is what we can go out and lend that on. So, uh, having Utah come back in a great way, having the Colorado market start to really kind of come alive again has been a very positive thing for us. We will take money as long as we have a use for it, and right now we do have a use for it. So we are looking at new money. I'll just wait one more minute for any more questions. Otherwise, we're going to wrap up here a couple minutes early. All right. If there's any other questions after the fact, please email us and we will do our best to get those answered. We will have a new investor communication coming out in about 45 days or so after the close of quarter 1. And be looking for communications from us for your K1s. And we will do our best to get those out as soon as possible. I can promise you I want them off my desk as much as you want them on yours. So thank you very much for being an investor in Indicate Capital. We appreciate the confidence. We appreciate the trust, and we couldn't do it without you. So thank you.